do I think that we're going to see interest rate rises? So if you go into any media, you see all these idiots that are on the news that are out there talking about the market, and they're talking about properties, and they're talking about interest rates and all that sort of stuff. They're all saying we're going to see interest rate rises and everyone's going to go bankrupt, right? We're saying everyone's going to get into trouble. If they rise interest rates, what we've got to understand is that interest rates, and I'm just going to go to this next slide. Here we are with our current rates. So interest rates, this is the last 10 years. This should have been a bigger chart. I asked my team to put a bigger chart here, but this one will do. In 2010, interest rates have come down, come down, come down, come down. Look at these long periods. Like this is about 3 years where interest rates sat at 150 basis points, and then they go down, they go down, they go down. The reality of it is that we're sitting at 10 basis points, which is 10% of 1%. If they went up by 0.5%, that wouldn't even get us back to where we were 2 years ago, right? But the thing is that if it went up from 10 basis points now that we've printed out trillions and trillions of dollars worth of debt, if it just went up to 0.5%, that means that the interest rate would go up 5 times to go up from 10 basis points to go up by 0.5%. So if interest rates go up, everybody will be totally and utterly screwed, which I'd love to see interest rates go up because it would mean a real market. But they have shown their hand multiple times. When we go back to that chart, you can see that, you know, it's that they've just dropped rates and printed so much cash that they've tried to avoid a crash, but they've created a new problem. And I said over the last 3 years that we've been going through this, we're actually going to our 3rd year now, that it's not the economy that's the problem, it's a cure of the problem, which is going to be the bigger problem. And I'll explain it more on the next slide. If we were to see interest rates double, it means that we'll go from 10 basis points, which is nothing, up to 20 basis points, which is a lot of money. It's 100% growth on that interest rate. If that happened, everybody would go bankrupt and broke out there. I personally think that as we go through the cycle that we will have glitches. Interest rates should be negative. The central banks have done something different and have not gone negative with the rates. And I will explain that in a second as to what they've done to print over that as we go on to the slide after the next one. But you need to look at the bigger picture when investing. If you're thinking about 12 months, 2 years, 3 years for your investment, if you're buying any of these properties today and thinking about 12 months, 2 years, 3 years for your property, you are a speculator, you are a gambler, and you are not an investor. You need to think about the bigger picture and think about how do these things fit into your overall strategy and your overall goal. So looking at, if interest rates were to go up, what is my prediction on it? And I've said this from the start, that interest rates will not go back past 0.5%. They will not go up by more than 50 basis points. If they do, it'll be amazing. But if it happens, everyone will be screwed. And I don't just mean homeowners here. I'm talking about every single area of the market, whether it be the government going broke, whether it be whatever. If interest rates go up by more than 0.5%, the whole system falls apart. It's financially impossible for them to do that. So look at the next 12 months, 24 months, that there has been volatility through all of these markets. I still remember, if you think about the interest rates, right, and you think about all these so-called experts and commentators on TV, like I remember going back 5, 6, 7, 8 years ago, they used to put me on TV as a puppet and try and get me to say, oh, negative gearing and all these sort of shit they put in my mouth. You see them all on the TV 2 years ago, and they said, oh, the house price is going to drop by 40% and this is going to happen, that's going to happen. It never eventuated. It's because they manipulated and created fraud in this financial space. So if they did do a few things, I have the exact answer as to what is going to cause the next crash. There will be a bit of volatility, but every market has seen volatility. It is in this report yesterday, and it is highlighted, and I will share that with you in a moment. So, yeah, a lot of noise out there, a lot of people regurgitating shit from the media. There's a lot of shit in the media, and they're regurgitating that, and it's hilarious to watch. but time will tell, common sense will prevail. And if they lifted interest rates by 0.5%, everyone would go bust. It's important also to go and take note of every country that has started reversing their monetary policy, and there's words that they use like taper, tapering, reversal of monetary policy, etc. Every country that has put up the interest rates, they have not gone and put the interest rates up by 0.5% or 1/4% or 1% or 1.5%. I think that the talking of interest rate rise is enough to fear the market, but most importantly, these countries that have put up the interest rates, I don't have it on charts here, slides, but go check it out. Whatever country has increased interest rates, they've increased their interest rates by 10 basis points, right? And that's had a big impact. So them just putting the interest rate up from 10% of 1% to 20% of 1%, right? It's not even 1/4% in total as the interest rate. Those markets have had to stop their monetary policy. So I do believe that we will start seeing the central banks try and tighten their monetary policy and reverse some of their actions. But as they do that, we're going to see the whole thing start to deflate, and they're going to have to re-inject it and reinflate it. And this could take 12 months, 24 months, and I'm starting to see these sort of patterns that are occurring out there in the market. Also with the interest rates, just one thing to be really, really cautious of. I'm seeing so many people out there fixing their interest rates. People come in for a MAP session, they're talking about their property portfolio, they're talking about their goals, they're talking about their existing properties. A lot of brokers are out there trying to refinance people's loans and then fix them on a 2-year mortgage. If your broker says to fix your home loan for a 2-year interest rate, what they are doing is they're not looking after you, they're looking after their own commission. So if you refinance your mortgage in a period of 18 months, the bank takes back the commission that's paid to the broker, so they lose their commission. So literally, if the broker spends 3 months getting you a loan right now, and then, yeah, they basically write the loan, and you refinance to a different bank, different lender, whatever, they lose their commission. It was like they never got paid. It wasn't that they didn't get paid, it's that they got paid and they had to pay that money back. So, yeah, looking at the brokers that are out there, they're putting a lot of pressure on people to fix the interest rates for 2 years. The banks have already factored in a lot of, interest rate movements inside of their policies because they've bought their funding on 3-year bonds, 10-year bonds, and however they've purchased and secured their funding. There's a lot of talk and a lot of fear around it. So without giving any sort of advice on that front, be very, very cautious. I did notice here, Chris has made a comment here, New Zealand have put up their reserve rate 50 basis points, so 225% rises since the end of their monetary policy. Let's see where that goes. Any higher than 0.5%, these markets do not exist. This chart, which I'm upset because I wanted to have it clicked on Max chart here, but I encourage you to go and look at interest rates in Australia on a chart. This chart is from a website called Trading Economics, so you can go and look it up yourself. But this chart should have been clicked on Max, but it's only a 10-year chart. But by clicking on Max, firstly, you can see here that in a period of 10 years, we've never seen one interest rate rise. Never before have we seen such a long period without an interest rate rise. But my most important part is that this interest rate of 4% going back here, in the GFC, it was about 7.25% in the GFC. Before that, it was up 9% and whatnot. So if we have a look at these interest rates as they come down, and you were to put a ruler, like I've got no drawing tools on this presentation, but if you were to put a line, you will see that these interest rates never get back to their previous highs. And that is very, very important because, the interest rates can't go back because there's so much debt that's getting printed. And the lower that the interest rates are going down, the more debt rapidly gets accumulated. So if the rate was 100 basis points, or the rate was 200 basis points, or the rate was 300 basis points. So you can literally look here and go, okay, 2013, let's call it, is there. And then down to 2 is 2017, and then down here is 2019, middle of 2019. we see that the interest rate where it is now has to go 10 times up to get to there. For it to go up by 1%, it is 50% from 1% to there. But to get from here is like 2,000% higher now. So the thing is that if someone borrowed $1 million at 2%, it would cost them half the amount to service for that. And then if you look at it now, it's next to nothing. So if they up this rate, all the debt that's been created in the last 2 years will cost substantially amount more. And one or two things will have to happen. One, it'll either crash the whole market and everything will get burnt down to the smithereens, or two, it'll have to come back down and they'll have to reverse course with the monetary policy. Problem is that people say, well, it's going to happen. It's, you know, it's bound to happen. They have to do it, whatever. They don't have to do shit, right? Just understand that all those loans and all that debt that has gone out there, the people that have taken that debt are the security. So the bank doesn't necessarily look at your house as a security when you're taking out the debt. They're looking at the fact that you have 30 years left on your work life, that they've got you on their cash flow books to bring cash flow through, and that is the asset to them, not the property. So the chance of this going up, the lower that it's gone, the more trapped that it is. And this is what's going to cause hyperinflation in the next decade. So whatever noise is out there in the media, they're not talking about this shit. Going back 2 years ago, they weren't talking about the same things that have happened in the market. So you need to make educated decisions for yourself. So be mindful when you're seeing all these news articles out there, interest rates could be rising, et cetera, et cetera. They could try, and I encourage them to. It'd be great. I'd love them to increase interest rates to 1%. If they took it back to this level, all the profits that we've seen in the last 2 years would be wiped off the table. But if all the profits were, that means that if properties have gone up by 50%, that means the banks would be in negative equity for all the loans that they've done. So it means the banks would be insolvent. It means the whole system would fall, which takes me back all the way back to 2016 when I said that we're going to go and see the GFD, which is the global financial depression, which we're in. The only difference is that they've dropped interest rates and papered over it. But that can't go on forever, and something has to give. They're going to try and reverse monetary policy, which I'll get onto on my next slide. However, they'll have to revert back to quantitative easing. A question or comment from Luke. Philip Lowy, under social and political pressure to increase rates, though he knows what will happen. It's checkmate. It really is. This is a market which, you know, you're seeing scammo put into the election. You know, I'm throwing all this money away. I've done a great thing. I've got, you know, 0% jobs. You know, I think it's 4% unemployment. It's the best unemployment ever. We've taken all the people that have, you know, not gone through the medical procedure off the list. You've manipulated those numbers so high, and inflation is now starting to trickle down into wages. But if someone's income goes up from 60 grand to 70 grand, it might seem like they're living the big life and the things are so great. But when they're going to the shops and they're going to Woolies or Coles or any of those big box supermarkets and they're pushing their trolley to the checkout and they're like, shit, I'm not getting much here, and all the stuff I'm getting is, you know, really bad quality, that's when people are going to start waking up from this. And it's very, very exciting. So Mabin just wrote, banks increase their rates citing increased funding costs. Banks also increase rates much more than the RBA rate. So 0.5% RBA increase may mean 1 to 1.5% increase to the common mass. Exactly. And one of the things that I have noticed very much so over the last few years is that the spread for the bank's profits, like when interest rates were much higher, the bank was making a lot less of a percentage. But as interest rates have gone lower, they've kept their buffer in place. So the bank's making much more profit. I think that's very healthy as well. And I think it's important to acknowledge that, because as these interest rates start to go into negative territory, everyone's talking about interest rate rises happening, but no one's talking about the fact that what happens in 2 years' time when we've got negative interest rates. It is inevitable that we're going to see negative interest rates.